Welcome to Profiletraders. This is Reza and you're listening to my market analysis for April the 1st. We are looking at a chart of ES here, S&P 500 E-minis future. And let's look at the big picture a little bit to see where we stand. I'm going to go back few months and analyze the situation. So we were in the month of December, right around here, where market was going up. We were retesting again this area where we have a flat top lined up around 2120, and then the whole year where the market wasn't doing much, the Federal Reserve was playing the good cop, bad cop scenario by half of them indicating that a rate hike was imminent and other half was saying that it wasn't sure. And finally in the month of December, surprisingly, Janet Yellen came out and jacked the rates in the middle of December. Right after that, we got the Chinese financial crisis kicking in again a second time. This here was the first time, and markets started to have I should not say one of, but it started to have the worst month of January in history. Obviously, a lot of blame went towards the Fed in regards to their timing of taking the rates higher in December, and we dropped very sharply up to a point where we came and retested this 1800 level. Obviously, if the 1800 level was going to be broken, it could have created a literal crash to the downside, which no one would be able to say where the bottom could have been. As a result, a full-blown Federal Reserve and central banks panic kicked in, from the Bank of Japan to the Central Bank of China to the ECB Central Bank to the Federal Reserve itself. All started to pour in trillions of dollars directly into the stock market in order to avoid another 2007-2008 scenario. And what was a very hawkish Federal Reserve in the month of December completely changed their tune and almost became apologetic about the fact that they had the guts to take the rates even up once in December. As soon as market heard that and saw the trillions of dollars coming into it, a very aggressive leg on the upside started. Now, why this leg has been so aggressive is because a lot of technicians, a lot of market players thought, because the fundamentals are not here to support a healthy economy, and a healthy economy is nowhere to be seen, that this Federal Reserve and central banks intervention was going to be short-lived, and they started to short in resistance areas against this last leg down. However, as it's been seen previously, when the majority of the market participants short and there is no response, the result could be very aggressive forced short covering to the upside. Now market is at extraordinary levels of resistance. If you recall, a long time I've been preaching that if it goes to the upside, market could reach between 2065 to 2070. and my calculation was based on this, the length of this last leg up duplicated on this leg up, and even this leg up equals this leg up as well. Basically, more or less every single time that we have reached more or less a 260 points of a parabolic move, which is the case right here, market has started to encounter significant resistance. Now there is only one uncertainty here. This top that we have in place doesn't look to be a good top, because we have not broken the top on the upside yet enough to trap the last patch of late buyers and then fail to follow through up, reverse back down, and then put into place a very solid significant top. Therefore, there is still an opportunity or a chance that since they took it up to this level, that they will do some more upside work in order to violate this flat top that we have tested the 2110 to 2120 multiple times, break it, and then upon the break to the upside, create a bull trap in place and bring the market down very sharply. All I say is that we are approaching very significant level of resistance, and we have a hefty move to the upside that is pure and 100% central bank based. The economy is so terrible that even if you listen to the Federal Reserve comments based on Yellen, everything is so soft, everything is so unstable, everything is so unpredictable that she will not even entertain the series of rate hikes that she planned for this year. And at the very most, if she does anything, it's going to be one more or maximum two more rate hikes. Now the question is that how much can the market continues to go up only based on rate hike gambles, and at what point the players will evaluate how far the market has come with a lack of economic fundamentals supporting it. So it's been a very brutal push to the upside. Possibly it still can continue until we finally clear that top of 21, let's say 20. And after that, I'm going to start to be extraordinarily bearish with this market, because a correction is absolutely due in this market. Now in the very short term, 2050 is the first level of support. Until we remain above 2050, either we are going to churn within these current levels or continue higher. The moment we do break 2050, we should come down fast, delete all these minus developments area of the profile. First area of significant support is the naked POC down there at 2026. And then of course, if a full-blown correction starts, we are going to go definitely much lower. 2018, there is another naked POC. And then finally, we should come for a test of 2000. And at that point, we will know the fate of the market. If the test of 2000 is just going to be a retracement of this 260 points move, and then market could find support at 2000 and then it would bounce back up, or if we do break 2000 with vigor, then the correction could be much more severe. Anyone that says this kind of euphoric upside move of 260 points is good, they're wrong. Healthy market pulls back so that newcomers have an opportunity to come in. Every time players are only forced and only have one choice, which is to chase the market, it's a clear sign and signal that you are dealing with a bubble kind of a situation. So let's see how everything goes on Sunday, but until 2050 doesn't break down, this thing can continue up until we finally take that top. And for it to reverse, I need to see a break below 2050. As for crude, I remember a while ago I told you 41 was a very significant resistance. I know in the very short term it did break above 41, but look where we are right now. We are at 36.62. So that level wasn't really a bad area of resistance when I called it. Based on the daily chart of crude, we are now in the process of a head and shoulder that did break to the downside. The measurement of this head and shoulder breakdown calls for a downside objective of 34. Before we would go to 34, we will have to deal with, of course, 36. Once we do clear 36, I'm expecting market to drop quite sharply to 34. Remember also that on the upside, the first level of resistance here comes in at 38.18. Then there is another POC at 38.6 and then finally at 39. Downside for now, 36 is the first level of support. If that level breaks decisively with good price expansion and volume increase, I'm expecting price to go towards 34. At 34, it should find very nice support, and that could become a very good buying opportunity, in my opinion, and it's not a buy or sell recommendation by any means. So this is where we stand. Very dangerous market, in my opinion. Very bubblish looking for ES. Crude is contracting, it's doing what it's supposed to do. Demand is simply not here. The oversupply hasn't been solved, and therefore there is a good reason to see price softening as we are, and further continuation down should be seen upon a break of $36. As usual, thank you for listening. This was Reza with Profiletraders. If you wish to learn market profile, join my trading room. Check my website. There is a very good affordable package, profiletraders.com. Have a good weekend.